Hello, I'm Laurence Fishburne. Today's investors are more concerned than ever about saving and planning for the future. As we're about to see, there are smart ways to make the money you earn today help prepare you for tomorrow.
Investors really need to truly rethink the way they approach diversification in a portfolio. The idea that buying a number of stocks up to 150, 200 stocks makes you diversified is not true. Equities all perform the same way in crisis environments. So it's important for people to build out a portfolio with what we would call an alternative investment strategy. Trend following or managed futures would be that type of strategy.
Trend following is a managed futures investment strategy. It's a systematic approach that's practiced by commodity trading advisors, also known as CTAs. And a trend following portfolio would be fully diversified, encompassing a wide range of futures contracts, from commodities like agriculturals, energies, and metals, to also financial futures like stock indices, currencies, interest rates.
Managed futures strategy, especially trend following, are done in systematic manners, both in risk and positioning. These systems have been designed by research experts who have spent their life researching markets and have then programmed systems to make trading decisions based on price data.
The systematic nature of trend following takes away emotion, ego, and subjective decision-making when it comes to portfolio management, thereby eliminating a lot of the human biases that can often lead to poor investment decisions.
Trend following models have been designed in such a way as a standalone investment. They make money on their own over the long term. But the real value of this type of investment is when you add them to a traditional portfolio of stocks and bonds, the diversification they bring will increase the risk-adjusted performance of any portfolio.
The strategy tends to perform particularly well during extended equity drawdowns, like the tech crisis of 2000 or the debt crisis of 2008. Because there's no long or short bias in trend following, the strategy can take advantage of those negatively trending environments. So it acts as a buffer or crisis alpha to an overall portfolio. There is no perfect trading strategy. Trend following is a strategy that involves risk. It's not a guarantee. There are certain market environments that are particularly challenging for trend following, like non-trending, choppy environments, and sharp reversals. So drawdowns are a naturally occurring dynamic with the strategy.
Trend following should be viewed as a long-term strategy that's non-correlated to other investment strategies. By introducing trend following into a portfolio, you are able to decrease its overall risk, but also increase the performance of the portfolio. It's a win-win situation.
Managed futures is probably the most liquid, transparent, and regulated asset class available to investors. More investors should be aware of the benefits of trend following as they plan their portfolio. They would be doing themselves a service.
We hope this program has served as an inspiration to you. Be sure to join us next time as we continue to profile the thought leaders impacting business. I'm Laurence Fishburne.